Hello and welcome to Market Domination. I'm Julie Hyman with Jared Blickery in for Josh Lipton today, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here is your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
This is a soft landing, strong job growth, low levels of unemployment, high labor force participation rate. It's all the things that you would want.
This is good news for the economy. Markets have been very focused on growth, so I think that given the earnings backdrop in the economy, we can continue to see the markets take this in stride. But I expect that it will have a major impact on the Fed's decision next week, likely to price in fewer interest rate cuts for the remainder of this year.
That could go down. It's going down. It's going down. In general, educational advice here in general, not specific to games. But remember, with all investments, especially ones I'm involved in because they're inherently very risky, they go up, they go down. You can't explain that. They go up, they go down. You can't explain that.
Large share prices usually are positioned for institutional investors who tend to be more long-term and their decision making is long-term, and so they're not as visceral in their reactions to maybe an earnings release or some other news event that would cause them to sell out of an entire position relative to retail investors. So that can lead to heightened volatility as you start to dilute the institutional buyers.
We have 1 hour to go until the market close on this Friday. So let's start with a look at the major averages here. Not seeing much change here for the Dow Jones Industrial Average. Now, you heard a little bit about what we got this morning from the jobs report. 272,000 jobs added to the U.S. economy last month, but the unemployment rate ticking up to 4.0% and year-over-year earnings continuing to rise, average hourly earnings. So all of that equaling not a lot of activity when it comes to movement here. Up about 48 points on the Dow, the S&P 500 up about 0.1%, the Nasdaq down about 0.1%, as investors are weighing what should we be doing here? What is the Fed going to be doing here? And speaking of what the Fed's going to be doing here, one of the closest proxies for it, the 10-year, is moving up pretty substantially here today, 4.43%. So, we're going to talk a lot of guests about this today, this sort of digestion period. Okay, we're still seeing this job market strength, but is the Fed going to be able to cut? There's a lot of questions around this. This indicates feeling that maybe the Fed is not going to have some room to cut. And then as we look at how all this is playing out among the sectors in the S&P 500, real estate and materials and utilities are down, so sort of more defensive in some cases, more interest rate sensitive. We have some strength in the financials and the industrials on the flip side. And then there, of course, is the sideshow that is going on today, which we're going to talk about much more in just a bit. But I can't resist taking a look at GameStop here, and in the words of Keith Gill, as we look at this stock year to date, you go up, it goes down. You can't explain that. It goes up, it goes down. You can't explain that. Jared?
I love a good risk disclosure here, and that just kind of encapsulates it all. Meme trader, sticking with the theme, Roaring Kitty, hosts a live stream reiterating his thesis for betting on GameStop.
If you just change one factor, and that's that you don't think Ryan Cohen is a doofus, all right? If you don't think he's a doofus, and he's not a fool, if you don't think that, and all of a sudden, suddenly, they're sitting on billions of dollars in cash, right? And you actually think not only is he not a doofus, but he's extremely talented in that he has the capability to turn this around. Even if you don't agree with that, right? Even if you don't believe it, that's fine. If you just pause for a moment and think about that, I think it really changes your mindset, and that becomes the bet.
Nice branding in the upper left there. This comes as a video game retailer reveals a decline in net sales in the first quarter and a stock sale plan. Head moderator of Wall Street Bets, Noor Al-Along, along with Tom Bruni, StockTwit's head of market research, joins us now to discuss. And thank you both for showing up here. I was fascinated. And Tom, let's begin with you. Your overall impression, Keith Gill there, talking about some risk disclosures, kind of selling Ryan Cohen, but we still don't really know the plan, do we?
Yeah, that's exactly right. And I think nothing says this uncertainty better than the fact that the company released earnings today, but is not hosting an earnings conference call for the 5th quarter in a row. And so it's the situation where there's a lot of hype around the stock. Obviously, the stock price has risen quite a bit, and the company is doing exactly what it should do. It's raising money on the back of that, and it's buying itself more time to figure out what the ultimate plan is. But that's the key question here for retail investors and anyone involved in GameStop is, their balance sheet is fixed. They're not going bankrupt anytime soon, but what are they actually going to do to turn their core business around and make a profit from selling video games or whatever else they come up with?
Noor, I want to bring you in on this. Does what Tom is saying matter, right? Or is this right? Or is it? Go ahead.
Yeah. No, that's exactly what I was going to say. It's if you're a trader, then you love this volatility. If you're in it for the long haul, then you're super excited that GameStop now has $5 billion or will have $5 billion of cash on hand. So either way, it's a win.
Well, let me just follow up on that, Noor. What's your impression of this much anticipated reveal by Roaring Kitty versus some of the other appearances? We haven't heard him speak for a few years. How is this different in any way?
I think he's completely on brand for who he is. We saw the exact same authenticity that we did 3 years ago. Really, I think this is just to put to bed all of the rumors and accusations that it wasn't really him, that he sold his account, that he was hacked. And it's not the case. It's him. It's authentic. It's real.
Right, and he also pushed back against some of the rumors and speculation out there that the money that was put into GameStop was not his, that it was being funneled through another entity. So he said that's not the case. Tom, what has the discussion been like on the StockTwits community around GameStop? I mean, anecdotally, when you were looking at that live YouTube live stream and looking at the commentary, it seemed like people were pretty pumped. But I'm curious what you're seeing and hearing.
Yeah, absolutely. I think coming into today's live stream, I think the expectation from most people was that we were going to get some clarity around what Roaring Kitty's ultimate investment thesis is at this point. And I mean, the clip you played before kind of outlined it, right? It's a bet on Ryan Cohen. And so, his live stream kind of reiterated the fact that he doesn't quite know what the company is going to do. The company doesn't quite know what it's going to do yet to kind of turn its core business around. And he's really just making a bet on the fact that it has a ton of capital available to it now, and that he believes in Ryan Cohen as the person to lead the ship. And so, there is a lot of skepticism around the broader motivations for his return and just kind of like where this all leads, because we're kind of back to the same situation as we were pre-Roaring Kitty, which is, okay, GameStop's an interesting situation, but again, how are they going to fix the business? Or is this kind of like just another flash in the pan where, traders take advantage, there's a lot of volatility, it's a lot of fun, and then, the earnings chicken comes home to roost, and you have to deal with the actual underlying business at some point.
Noor, I'm interested in your take on the community. You're a moderator at Wall Street Bets, and you've seen that. You've been in the action for a long time. Has the community's tone shifted in any way? Are there more concerns now? Are people still gung-ho? Do the diamond hands prevail? What's the temperature?
I think we've definitely seen a shift in the way Ryan Cohen is perceived. He's being seen a little bit more as a villain in the past couple hours, specifically because he decided to release earnings earlier than expected, kind of putting a dampener on the rally.
Villain or not, the earnings are not good, Noor. Let's just say that flat out, right? Sales fell 29% year over year. The company still is posting net losses. The stock, while it's been all over the place, and as you say, volatility is good for traders this year, it still hasn't reattained the highs where it was back in 2021. I have to say, Noor, first of all, do you still hold the shares? And why do you still have faith in this thing if you do?
I do. And I think a big part of it just comes back to the fact that the core thesis hasn't changed. The business itself
he's had all this time to fulfill that core thesis, Noor. When you look at GameStop, the thesis now is the same as it was, but it hasn't come to fruition. right? Ryan Cohn hasn't done anything with the thing, and he's not telling anybody what he's going to do. He doesn't do conference calls. He doesn't talk to anyone. It's a complete black box.
It's true, but I think it's unfair to place it entirely on Ryan Cohn. If you go back to 2020 or even 2019, when DFE was really talking about getting into GameStop at the beginning, he was talking about a console refresh. Because of the pandemic, we haven't seen that. And we're still, coming around to maybe it'll be next year that we'll see all these consoles refreshed. So I think it's then that we'll see all this buildup finally come to fruition.
All right, we got time for one more, Tom, real quick. Anything we haven't covered here that you want to make the case for?
Yeah, I would just say part of the broader conversation right now is around whether this GameStop thing is a resurgence of kind of meme stocks in general. And from a StockTwits perspective, there are other stocks that are seeing a similar focus, but they fall into different categories, right? So in GameStop's situation, it has a good balance sheet. It just has fundamental problems growing its revenue, which is why it's not profitable. AMC, on the other hand, has a bad balance sheet and is not making money from its core business. And then you have something like FFIE, which is Faraday Intelligent Electric, which is an electric vehicle startup, where they don't have a good balance sheet or a core business. And so I think there's an interesting conversation around the different segments of meme stocks and what their actual longer term potential is. But in the short term, they all get caught up in kind of this, social momentum that's happening on platforms like StockTwits and Wall Street Bets and Reddit and all these other places. So just know the game you're playing. If you're a short-term trader, this is great. If you're a longer-term investor, you're waiting for these companies to really tell you, what are we going to do with this good fortune that we found ourselves in?
Know the game you're playing. It seems like you guys know the game that you're playing. Nor appreciate you being a good sport. Tom, you as well. Thanks for joining us, guys.
Thanks for having us.
We're just getting started here on Market Domination. Coming up in less than an hour, Nvidia will be much more affordable, at least if you want to buy a single share. The chipmaker's 10-for-1 stock split is set to take effect after the closing bell, and we'll talk about what it means for investors. Plus, what cooled down? Today's jobs report topped even the loftiest economists' expectations, with 272,000 jobs added in May. We'll discuss what this means for the Fed's rate cut timeline. And Lyft shares getting a lift in today's trade after multiple analyst upgrades. CEO David Risher will join us at 4:15 p.m. Eastern with more on what's ahead for the ride-sharing app.
Bond yields getting a major boost from May's blockbuster jobs report. The yield on the 10-year benchmark topping 4.4% today. And joining us now is Kelsey Barrow, fixed income portfolio manager at JP Morgan Asset Management. And thank you for joining us here today. You know, we didn't get the biggest reaction in stocks. The initial reaction was down, but the huge movement that I was tracking was in the bond movement. In the bond market, the 10-year up 15 basis points. That is the biggest jump in a couple months. What do you think this is signaling?
So certainly the markets right now are anticipating and have now had to readjust in terms of their expectations for the Fed later this year. So essentially, you know, there's a couple things that I saw in the jobs report today. I look at jobs itself. They were coming in hotter than expected. Wages also came in hotter than expected. Really, the only thing that was a little bit of a fly in the ointment was the tick up in the unemployment rate. So we have seen a gradual rise in the unemployment rate over the last, let's say, 6 months. The low was 3.4. Now we're at 4%. That's not concerning in and of itself, but it's just telling the Fed that they shouldn't be in any rush to ease policy. Now, for a fixed income investor, what we're a bit more focused on is not as much about when they're going to cut rates, but more the fact that they're done hiking rates. And that's a function of the decline in inflation we've seen. And so, you know, the next market event for investors to look forward to, in addition to the Fed on Wednesday, is CPI.
Right.
And that's going to be really critical.
Is there any doubt that they're done hiking rates?
Well, I think there is still a debate about if the Fed is right to be thinking about cutting rates, and is policy really restrictive? So in world, you know, there's still this debate over, is it a hard landing? Is it a soft landing? And I just want to dispel that myth and say, the soft landing already happened.
You're the second person who said that this week.
Really?
Yeah, that's so funny.
But here's how I'd extend the analogy. So we've landed, but the plane is still moving on the ground, and we're looking to taxi towards the gate, and we're still questioning, are we going to crash into the gate? Are we going to stop short of the gate? Or are we going to get right to the gate and have a nice entrance into the airport? So that's really still what the market is grappling with. And that's why you see these very intense moves in the bond market, because there is still a lot of uncertainty about how that taxi process is going to go forward.
Arguments, every month we deal with arguments and criticism about the way the reports are conducted. And to be fair, the survey response rates have gone down over the last few years since the pandemic. But there are two surveys. You have the establishment survey for businesses, the household survey for households, and they've been saying different things. What do you say to that?
Well, that is a really interesting observation. And when I talked about the different parts of the jobs report, you have the non-farm payrolls, which comes from the business survey, and then you have the unemployment rate, which comes from the household survey. The business survey had strong job growth, and the household survey is showing the unemployment rate rising. So that's a little bit of mixed signals. So what we try to do is take a little bit more of a mosaic approach, not just overweight one specific data point, but look more broadly about how things are going. And to us, what is most clear about the labor market is that it is rebalancing fairly significantly. You know, my favorite indicators are particularly in the JOLTS report, the job opening labor turnover survey. We've seen the decline in job openings and the decline in quits, and wages start to roll over. It's not a sign that the labor market is falling off a cliff, but it is a sign that in a way, things are moving into a more healthy balance.
And so all of that said, then do you think that today's move in the bond market is an overreaction? It sounds like maybe so.
Maybe a little bit on a one-day view, but you also have to remember we rallied a lot. Yields moved fairly substantially in the past few weeks in ahead of the jobs report. We had some very soft data on the survey side that was getting the markets a little bit concerned. So if you look over a longer period of time, I think we're still kind of in a reasonable range. The market is pricing in 1.5 cuts for this year, so that's between 1 and 2, and about 6 or 7 cuts in total over the cycle. So I think this move today was large in and of itself. We did see a large rally going into the report, and overall, I think the market is still reasonably priced based on our expectations that inflation is under control, and that will allow the Fed to cut in the fall.
And as you say, we'll get more information on Wednesday. Next Wednesday.
We will.
Thanks so much, Kelsey. Good to see you. Thanks for
Absolutely.
coming in. Appreciate it. We want to get to some trending tickers now. First up, Waystar not to be confused with Waystar, Royco, by the way. This is a healthcare payments software company having its initial public offering today at $21.50 a share. It priced at the low end of the range, and the shares are falling today. And by the way, this is the biggest U.S.-based company that is making its public debut this year. I was surprised too, because they only raised about a little less than $1 billion. We've had companies like Viking, which is the European-based river cruise company, for example. Reddit.
Not a big one,
is
but
Reddit not based in? But it was smaller?
They might have been smaller.
Yeah. So anyway, but you see the shares falling today, which maybe helps explain why we haven't seen more IPOs when you get a reception.
Yeah,
like
I think total this year with U.S. IPOs have only raised $19 billion. That's really low. And we've talked about the IPO turnaround. We're still waiting for it. It takes a while for markets to renormalize, and I don't think that the appetite has been out there. So
yeah, it doesn't seem so.
Yeah, but we cycled. We had so many. There were so many unicorns waiting for so long to issue after the pandemic. We got that flurry, and now there's a lull.
Yes, the lull is what's happening now.
All right, our next trending ticker is Geron, the biotech company, watching its shares soar after FDA approval of Rytelo, a treatment for blood cancer. And I was looking at some analyst commentary here. I do have a street wrap, and here's Wedbush. They rate the stock an outperform with a price target of $7, saying the label constitutes a best case scenario with no black box warning of any adverse events. So the backstory on this, there's a new blood disorder drug hitting the market. They had to get FDA approval. They don't have to put that big black box warning label on it, so that is seen as a potential tailwind.
And here's why this is really important. This company has no products. This is one of those biotech companies. This one has been public since 1996 and has had stuff in development. This would be the first go-to-market drug for this company, treatment for this company. So that's why it's a big deal, and a bigger deal, again, because as you say, it's not going to have that black box warning. Year to date, the stock has more than doubled. The market cap now is about $2.8 billion or so. But I find these sort of like pre-product biotech companies fascinating that can go on for years and years. And then finally, their research sort of comes to fruition.
You know, and the charts of these companies, they all kind of, they all rhyme. And if we can go to the Wi-Fi Interactive, I'm going to show you the year-to-date first. Looks like a normal chart, but let me just show you the last 20 years. All of these spikes here, it almost looks like a meme stock. Every few years, somebody gets interested. But these are approvals. These are new drugs. People getting excited. These are just press releases, one way or the other. And in the end, there's just a tremendous amount of volatility. But if I put the max chart in, you can see way back around the .com bubble and bust, there was that huge spike there. So they have been higher in the past.
Yes, they have. So we'll see what happens when it actually comes to market. And then another trending ticker we're looking at is Oddity Tech. This is the beauty company. The shares are surging after the board approved a buyback program of up to $150 million. It also hiked its outlook for the second quarter ending June 30th. The company now expects revenue for the second quarter of 2024 of around $189 million. It had been $185 to $189. The earnings per share forecast going to 69 cents from 56 cents. The stock recently got hit by a short seller coming out, a Ningi Research, publishing a short report on May 21st. The stock took a tumble. And so the company has come out and pushed back against that report, but this then also seems to be sort of in response to that.
I have a note here from Truist, and this analyst is noting the buyback is opportunistic, and so that kind of reminds me, you hear Warren Buffett talk about buybacks. He wants to do them at the right prices, and that's kind of what this gets to the heart of. The analyst saying this is the first ever authorization that allows the company to take advantage of material dislocations in the stock price. We believe ODD, that's odd, has ample financial flexibility to deploy this repurchase program while investing behind its growth initiatives. And I also learned that they are the owner of Spoiled Child.
Yes.
And
Il Maquillage.
Okay, is that what it is?
That's the other one, yes.
All right. Well, good to know. Coming up, Nvidia is about to get way more affordable. More on what the stock split means for would-be investors and the chip space at large.
Nvidia shares are about to become more affordable, at least if you want to buy a share versus a fraction of a share. The tech giant will complete its highly anticipated 10-for-1 stock split, where investors will receive 9 additional shares after the market close. The stock's going to begin trading at the split-adjusted price on Monday, June 10th. Joining us now, Stacey Raskin, Bernstein Managing Director and Senior Analyst. Stacey, great to see you, as always.
Good to be here.
So, I know that you like to look at the fundamentals of this company, and there's a lot to say about that. But before we talk about that, let's talk about the split and whether you are also factoring this in as a potential catalyst.
So look, fundamentally, it should mean nothing, as we know. In practice, there is I guess for a lot of these stocks, there is increasingly a retail presence. And to the extent that it makes it more attractive for retail, I mean, maybe, but to be honest, I think it's at the margin. I'm not really factoring in very, very much. There's plenty of liquidity in this stock anyways. We don't need the retail investors to drive it higher. It's not the first time they've done a split either, by the way. They did a 4-for-1 not that long ago, maybe a couple of years ago.
Right.
And they've done splits in their history, but it wasn't that long ago.
Right, and the stock went up after that, but you could argue that was, because the company was growing. I'm just curious, this is just for my own knowledge, you and your other cohort of analysts, so how does this work? As of Monday, do you come out with another note and your new price target is just a tenth of what it has been?
No, actually in practice, they will handle, like on the back end, they'll cut my earnings presumably by a factor of 10 and the target price by a factor of 10. The next time I publish a model, I will publish a corrected one. And the only impact there is I'll increase my share count by 10x, which would reduce my EPS by 10x. But it all scales. Like, it's fine. I don't have to do very much except change one line in the model next time I publish the actual model. That's all.
What's fascinating to me is that, as you note in one of your reports, the shares remain relatively inexpensive, looking at a 35 times forward earnings multiple. Anything you see changing that?
Not yet. I mean, one of the, to the extent that there are bear theses on this stock, I mean, people are worried about, air pockets, CapEx digestion, that sort of thing. I think going into their last earnings, that was a worry. They've got a product transition from the current generation, which is called Hopper, to the next generation, which is Blackwell. And people, I think, were worried about some kind of an air pocket in front of that transition. And the company kind of took that off the table, I think, on the print itself. At this point, I mean, look, at some point, maybe we'll see something like that, but it definitely does not seem like it's now. Like, numbers this year look really good. My guess numbers next year are going to be fine as well. They probably go up. And I mean, I guess calendar 2026, I guess we'll worry about that when we get closer. But it ain't the time to worry now.
I mean, and if you look at the out years and you look at what the revenue estimates are, for example, I mean, the numbers are going to get smaller in terms of the magnitude of growth.
The growth. Yeah, look.
Or are they? Or are they? Are we
forever, right? I mean, fine.
So what's well, and I'm just curious. When you hear, of course, we've got Hopper, we got Blackwell, now we got something called Rubin coming down the pike. At what point do you think there's this risk here of, the relentless need to offer more and eventually disappointing the market?
Well, I mean, who knows, right? Look, I think you're asking a slightly different question. Like, when does this all come to a head, if it comes to a head? And like, we can argue about cyclical air pockets like digestion and that's fine. It'll probably happen at some point. That's not structural. I think the structural worry would be, over the long term, like, there's a lot of money that's getting spent. And there has to be a return on that investment, either driving revenues for customers or driving efficiencies and saving costs, or ideally both. And if it were to turn out that, given the amount of money that's being invested, that the returns just don't justify it, then the whole thing would presumably come crumbling down. I mean, for Nvidia and frankly for lots of other folks, right? So I think that would be like the long-term structural worry if you're worried about this kind of rolling over like permanently. I personally don't believe that's the case. I do think that there are use cases here. I think companies are already starting to generate returns. They're starting to build business models. We're still early. Clearly, we're still early. But I don't worry too much about it. But I mean, to the extent that you are worried about some sort of structural issue, that would probably be it. But again, it's not now. It will be, we've got a few years of investment to come before we come to that conclusion one way or the other.
So what are the shorter term consideration or concerns that you might have over the next couple quarters with regard to the stock?
Yeah, look, I think the numbers should be fine. I mean, numbers should go up, probably. I mean, the question is, how is that relative to expectations? Like sometimes you see stocks beat numbers, and yet the stock itself goes down. And that's because what really matters is not so much my numbers or my competitors' numbers. It's the actual buy side, the investors' numbers, which tend to be higher typically than the Wall Street analysts that you sort of see on the screen. For now, though, like I said, I suspect numbers probably more likely have an upward bias than a downward bias. I'm not really worried about any kind of, like I said, near-term air pocket. On their call also, they kind of suggested that the Blackwell, which is their next generation, the Blackwell ramp is ramping earlier than people thought. I think in the near term, things look pretty good. The question will just become as we get closer to earnings and other things, how high do expectations go into those prints? And then like, what do things look like relative to those expectations? That'll be the worry for the next few quarters. But the raw numbers themselves, I think should be fine at this point.
Hey, Stacey, let's switch gears for our final question too, because I want to ask about Broadcom, which is reporting next week. You recently came out with a note and said you like it. For people who aren't as familiar with Broadcom, where does it sort of fit into this whole new AI universe, and why are you bullish on it?
Yeah, you bet. So Broadcom does a lot of things. They have a semiconductor business. They have a software business. They do a lot of infrastructure work. They also have what I would call the second best AI story in the space, I think, after Nvidia. One of the competing factors to Nvidia is actually like the large hyperscalers, like the Googles and the Metas of the world, are actually doing their own chips. And in most cases, they rely on other outside partners to help them do that. And Broadcom is one of those partners. Broadcom does the AI chips for Google. Google calls them TPUs. They've been working with Google for 8 or 9 years. They're working with Meta as well. They're working with some third customer that they just disclosed recently. They also do AI networking, Ethernet for large language models and generative AI. And networking, frankly, is just as important as the compute. And they're the 800-pound gorilla there. And their current guidance for their AI revenues this year is more than $10 billion out of a $30 billion semiconductor outlook that they're looking for this year. So it's like a third of their semiconductor business they're looking at to be quote unquote AI related this year. And again, what we've seen from everybody in AI, it's one of the few end markets that's doing really, really well. All of these folks have been seeing upward biases to their number. That 10 billion feels fairly conservative to me, but it's what I would call, like I said, the second best AI story in the space after Nvidia.
All right, and we will find out the results next week. Really appreciate you stopping by here on a Friday afternoon. Stacey Raskin.
You bet.
And turning to the key economic data driving the market today, the jobs report. The economy adding 272,000 jobs in May, coming in above expectations, as did the unemployment rate, unexpectedly rising to 4%. Joining us now is Deutsche Bank senior U.S. economist Brett Ryan. Brett, thank you for joining us here. We were just talking with an earlier guest. The reaction in this report really wasn't felt in equities so much as a bond market. Biggest jump up in the 10-year in a couple months. Overall, what are you just making of the report?
Yeah, sure. So, as you noted, it was a solid report, but the unemployment rate did tick up, and there are a few specific reasons why. But I think the bigger picture here is that there's really no change in trend from what you've seen over the last 12 months. And I think going into the report, you had the bond market was really rallying and seizing on this idea of, a step down in the labor market that was going to be evident in these data. And, there really wasn't a fundamental reason for it, to be honest. But, what did we get today? The headline 272 gain and private 229 gain, they were moderately above their 6-month averages of 255 and 202. And the three sectors that have been driving non-farm payroll gains, namely government hiring, which was up 43,000, leisure hospitality, 42,000, and private health and private education health services, 86,000. It's the same story that it's been for the last 12 months. So I think it was more of a relief there that you're not seeing a bigger slowdown, and equities weren't going to participate because that takes pretty much the Fed, a Fed cut off the table in July. We think the Fed's going to want to kind of keep the door open for September, perhaps. But in our view, these data point to the Fed not cutting until December.
Hey, Brett, can you help us understand the gap between the two surveys? Whether this, I know it's not unusual to have a gap. Was the gap between the two, the magnitude of the gap unusual between the establishment survey and the household survey?
Right. So the household survey was obviously less positive, with a 408,000 decline in employment, with a 157,000 increase in unemployment, which brought the unemployment rate up to 4%. That's the highest since November 2021. The issue is, on a monthly basis, employment and household and unemployment are very volatile. They're very volatile. This is a survey of 60,000 people. And so, but the way to compare these things is in the year-over-year growth rate, because over time, the year-over-year growth rate of household employment is going to generally track that of the establishment survey. One of the things, though, that's interesting in what's weighing on the household survey growth rate is 20 to 24-year-olds. So employment for 20 to 24-year-olds is down 6% year over year. But employment for 25 to and above, and particularly prime age, is up 0.7, a more healthy 0.7%. That's closer to what the establishment survey is showing. And, it doesn't explain all of the gap between the household and the establishment survey in terms of growth rates. But another thing that may partly explain that gap is immigration. The establishment survey is more likely to pick up immigration impact.
Do people under 25, are they just less likely to answer the phone? Also, Brett, I don't know what the methodology is exactly for the household survey, but you have to imagine it's gotten harder to even conduct these surveys.
Well, I think, it's not necessarily that, more than as we get further away from the pandemic, and people are returning to college and schools and graduate schools. And, during the pandemic, when, people delayed education, and you saw a big jump in hiring among the younger age cohorts that had delayed colleges. So I think it's really more reflective of, number one, it's May, and it's always difficult to seasonally adjust around these age cohorts. But two, it's a return to education and getting degrees more than anything. Mm-hmm. I think the way the Fed's going to look at this is, look, prime age employment is up 0.7% year over year in the household survey. The establishment survey growth rate is still solid at, over 1%, near 1.5%. The income from the payroll proxy, which is hours, wages, and jobs, is growing at 5.5% nominal. All of this is supportive of continued continued consumer spending. And there's really no smoking gun here that would say the Fed should be in any urgency to cut rates preemptively. So, it really becomes down to an inflation story.
Next week, want to get your thoughts on what we're going to see next Wednesday. A couple big things, CPI and also the next Fed meeting Wednesday at the close. What are we going to be thinking?
Yeah, so the fact that you have the CPI report on the morning of the meeting does add uncertainty into expectations for this report. And the Fed couldn't guide that much ahead of the time. Obviously, we expect them to remain on hold, as Powell had talked about. It's really going to be about the summary of economic projections and how many rate cuts they take out based on the latest data. They're going to revise up their core PCE inflation forecast. This should be a hawkish outcome. And I think the Fed's going to want to keep its optionality, perhaps, to cut rates before the election, perhaps at the September meeting. But I think they're going to raise the 2024 and 2025 dots to take out 25 basis points of cuts, and with little other changes. And I think you're going to see the long run dot tick higher as well. So I think it's going to be more of the same. The Fed's going to say, listen, we see continued progress in better balance in the labor market. We need to see more confidence on the inflation front. And in that environment, we're on hold until we've gained that confidence, and that's going to be several more months of data on inflation.
So I guess we'll keep watching all these individual reports very closely. Thanks a lot, Brad. Good to see you.
My pleasure as always. Thank you for having me on the program.
Of course. Let's get to some calls of the day now, including Lyft getting 4 different upgrades today, including a double upgrade from Bank of America Securities. The shares not really benefiting here right now. We were seeing them go up yesterday, and that's after the company did update investors at an investor day and talked about an increase in its bookings forecast. Now, Bank of America's upgrade here says that, they had an underperform on the company back in September of 2022. The analyst saying Lyft has made significant underlying improvements since then, including greater cost focus, much greater focus on share count dilution, and the introduction of Lyft Media, which is folks getting served ads when they're in the app waiting for a car or in a car. So that's what Bank of America was looking at for that upgrade.
Real quick, I just want to show the Wi-Fi Interactive where I have our mobility heat map for the year to date. And interesting to see Lyft here. I'm going to circle it in green, up 4.3%. Uber's up 12%, DoorDash up 15%. And not necessarily, some of this is apples to oranges, but we see some other mobility names that are just kind of tanking here, and it's really in the rental space. So it was looking better. It's looking better here for some of the pure play ride shares.
Yeah, and Lyft has had a little bit of a rocky time as well with some of its guidance that it has given in the past, a little bit of confusion about that. But this investor day does seem to have reassured folks to some extent.
And be sure to tune in later at Market Domination Overtime. We're going to have an exclusive interview with Lyft CEO David Risher at 4:15 p.m. Eastern. And Tesla shareholders are voting on CEO Elon Musk's $56 billion pay package next week. And for the details, we're bringing in Yahoo Finance's Praz Subramanian. This is a big one. We're talking tens of billions of dollars for one individual. What should we expect?
Yeah, big drama next week coming up on that shareholder meeting on Thursday. Robin Denholm, the independent chair there at Tesla, posted an open letter yesterday talking about how they need to pass this package to retain, quote, Elon's attention and motivation. Also writing that Elon has, quote unquote, other places to go to take his ideas. I don't know about you guys, I found this to be remarkable. I've never seen an independent chair write an open letter supporting a CEO's pay package. In 15 years of doing this, I've yet to see that. I don't know if you guys feel the same way.
I don't recall that, yeah.
It's remarkable to me. That being said, we also have a couple bulls like Cathie Wood talking about how Elon's interests are aligned with shareholders most strongly of any CEO. Ron Barron, of course, saying Elon is the key man of key man risk. So, some bulls are on board there. And for the most part, most people expect the pay package to survive and to be overwhelmingly passed, according to Dan Ives. So I think we might not see that drum, but there's going to be there's a lot of shareholder groups and also ISS and Glass Lewis talking about how this is not a good thing for shareholders. So we'll see what happens next week. But I'm just surprised by the push by the board to get this package passed.
Yeah, and the other question is, even if they do approve it, what will be the reaction from Musk? Now that he has held he's holding the company hostage in some ways by saying, maybe I'm going to take my AI tech somewhere else, for example. Okay, so does that mean if they do approve it, that's off the table? Or is he still going to sort of needle, I don't know. He's unpredictable, so it's hard to say.
It sounds like to me that they're saying, hey, if you give him the money, he'll stick around. He'll be the key man, as they say. He'll be around. He'll focus mostly on Tesla, which to me seems a little bit strange to have to kind of financially sort of motivate the CEO to stick around. Usually it's...
Well, even before this whole pay package fight happened, he was splitting his time between his various CEO-doms. So we'll see.
Yeah, I think the expectation is, yes, he better stick around if we're going to approve this massive pay package.
Pras, thank you. Yeah. Looking forward to next week. Well, coming up, there is big opportunity in climate innovation. If you know where to look, we'll discuss the best position names next on Market Domination.
As infrastructure for data centers ramps up, thanks to the AI boom, industrial companies are in a prime position to see big gains. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Joining us now is Evelyn Chow. She is a climate innovation portfolio manager at Neuberger Berman. And thank you for joining us here today. We talk a lot about the AI trade, and there are a lot of different components, and a big one is power. So tell us about the industrial side of this.
Yes, I think one of the things that I love about industrials the most is that to invest in industrials is to invest in innovation. And a lot of that is climate innovation, because when you think about what companies are creating renewable technologies, improving our aging grid, addressing water infrastructure, a lot of that is happening in the industrial space. And so one of the ways that we've really seen this express itself over the course of the year has been in this AI electrification beneficiary trade. I think there's a lot of different ways to play that, but one of the things that's really important to bear in mind is just how much power is going to be required to power these data centers. So you want to have clean generation and an improvement in energy efficiency, and that's really important to achieve.
Evelyn, it's interesting because it seems as though investors are starting to catch on to this, right? Yeah. But we've seen this big lift in utility companies that are going to be providing that energy. The lift in industrials has been less. Now, of course, it's a more diverse group. It's not just energy related. But do you think investors are starting to catch on to this as well, their connection to that thesis?
I think so. I mean, one of the really interesting things about industrials and the XLI year to date is that it actually was keeping pace with the S&P for most of the year, despite the absolute dominance of mega cap tech in the equity market narrative. A lot of that has stemmed from the participation in AI and electrification. So you see a real bifurcation in these organic growth and earnings growth profiles for companies that are benefiting from the theme. I think you've started to see some recognition in data center equipment providers, thermal management. There are a few that I'd love to highlight, and we can go into that. So one of the ones I really like best is a company called nVent Electric, ticker NVT. It's a somewhat underappreciated mid-cap company that's emerged as the leader in liquid cooling. Now, liquid cooling is a technology that Jensen actually referenced several times on the last Nvidia earnings call, and it's really critical because AI data centers have 3 times the power density of a traditional data center. Liquid cooling reduces your energy usage by 50%. And so nVent is taking tons of market share in this space. It's also improving its margin profile, continuing to consolidate a very fragmented industry, and it actually just announced an acquisition yesterday at a very reasonable multiple.
And then you have a company like Eaton, which has been around for, this is, nVent is a new, kind of a newer school technology. Eaton does a lot, it's pretty diverse industrial. So what are they doing with this, with regard to this new area?
Yes, Eaton is kind of like nVent's big brother. So it's an electrical juggernaut. It does a lot of stuff within the data center space. It also has very significant representation in utility, which, as you noted, Julie, is going to be really important because you need to have all that power in order to power the data center. The thing I like about Eaton is it's an early mover in this space. It's got a great management team, a very strong track record of execution, and I think they're going to be able to grow, mid-teens earnings growth over the foreseeable future, which, it ties in very much to my belief that right now it is worth paying a bit of a premium for quality when you have so many macro cross currents at play.
One more name that I'm interested in, Xylem, and this is an integrated water solutions provider, and so not necessarily electricity, but another essential component here.
Xylem is very critical as well. Our water infrastructure is absolutely ancient. So if you thought our electric grid infrastructure was old, you should take a look at water. It gets a failing grade from the American Society of Engineers every single year. Xylem is in pole position to capitalize on this. It last year bought its pure play peer Evoqua, and now it's in a position where it can provide an integrated offering in both the institutional and commercial verticals. It also brought in a CFO who's very well regarded for his ability to integrate deals and to pursue further M&A. And so I think this is a really fragmented space where Xylem could continue to do a lot of work. There's also a kicker as it relates to PFAS remediation, which has been top of mind among environmental concerns.
All right, we're going to have to leave it. Did you have another one? All right, we will leave it there. Thank you for stopping by on a Friday afternoon. Evelyn Chow. Thanks.
Thank you.
And while we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for more market domination overtime.
Closing bell on Wall Street, and now it's market domination overtime. We're getting you up to speed on the action from today's session. Let's see where the major averages ended up or ended down, as the case may be, because we did see a mixed picture, just slightly higher trade for the Dow at 3 p.m., but an hour later, it's down about 0.25% or about 88 points. The S&P 500 off 0.1%, and the Nasdaq off about 0.25% as well. This is after we got that better than estimated non-farm payrolls number this morning, leading a lot of investors, Jared, to say, well, maybe we're not going to get those cuts as soon as we thought.
Yes, and really the movement was in the bond market today. If we go to the Wi-Fi Real Interactive real quickly, I'll just show you the sector action, and it was financials. Those take the lead today. XLF up 44 basis points, followed by tech, XLK, industrials, and healthcare. Utilities and materials down 1%.
Well, let's get to what's going on in the big picture here. The chances of the Fed announcing a rate cut next week decreasing today after the release of May's blockbuster jobs report. Not just decreased for today, but decreased for the other meetings that are upcoming as well. Joining us now to help us figure out what comes next is Stephen Whiting, Chief Investment Strategist at Chief Economist at Citi Wealth. Steve, it's great to see you. And
thank you.
We obviously could use your help as we try to figure out what these numbers mean as we go forward here and what they're going to mean for the Fed. It feels like the Fed is much more oriented towards strictly inflation data. Nonetheless, we had a little bit of inflation data in this report today in the form of average hourly earnings, which is not terribly helpful for the Fed.
Well, look, when the Fed tells you that it's data dependent, and unfortunately, the U.S. government releases contradictory economic data in the same report. So you have to take a step back, and that's very difficult. It'll be difficult for policymakers. Investors have to make real-time decisions on this data. But let's just consider, the U.S. government told us that 272,000 jobs were added in the month of May, and 408,000 jobs were also lost in the month of May. That's what was in the household survey. Now, again, it's more volatile. That particular contradiction, both Bureau of Labor Statistics data, that can happen, but it's quite severe. Over the last 12 months, there is a massive gap between these two surveys. You've seen the unemployment rate rise from 3.4 up to 4%. You've seen 4 million job openings disappear. So a lot of signs do not suggest that the labor market is overheated. Even if we took the establishment survey, over the last 12 months, 2.8 million jobs were added, over 6 million were added in 2021. So if you really zoom out from this data, think about the fact that we had 100,000 more than consensus roughly. Last month, it was 100,000 less than consensus. You just can't use this month-to-month data to really determine what the economy is doing and what the economy is capable of. I think that the Fed is going to look at its policy rate at 5.5% and say, you know what, we can wait a little bit longer. Let's see if anything changes. Sometimes that can be a mistake, but I think it will be okay for us to hold off at least until September.
I want to fast forward to next Wednesday, 8:30 a.m. We get CPI. Powell's eating his cereal that morning. What is he thinking as he heads into the room that day? Because the FOMC is also deciding what interest rate, what monetary policy is going to be. And they're not expected to make any big moves, but it should be a big day, I would think.
I think they're going to say, what does this mean for our preferred inflation gauge, PCE deflator? We might call it inflation for the things you can still afford, for rapidly changing basket. It's by design has been less volatile. It's been making progress. Even if you take a look at the first quarter data, which bounced back for the CPI report, we've come down a lot. It never showed the 9% gain that the headline CPI did. It peaked in the neighborhood of 7, but now it's below 3. And that's progress. The Fed's inflation target was meant to be reached over the long term. They looked back and said, we were short of our target in the last 10 years. We're above our target in the last 10 years. You can't really micromanage these things so well. The pace at which inflation is declining is not very rapid. Certainly the price level. The reason that the public is still feeling pressure is we never erase price levels. We never deflate prices down to where we were before a major shock like the pandemic. And the Fed's has already clarified for us. Chairman Powell said that's not going to be the new tactic of the Federal Reserve to deflate us down to price levels where we felt better about things a few years ago.
So if we're still waiting for the Fed to cut at some point in the future, Steve, and we are seeing those price pressures continue to weigh on consumers, we've also had some signs this earnings season maybe a little bit of softening in demand for enterprise spending in certain areas. What does that all mean for stocks?
So the gains that we just had, 17% over 6 months, we're not expecting 34%, right? So we think that the market has come a long way from this view of collapse and inflation at the same time last year. But I think we have a much broader profit recovery going on across industries. It wouldn't surprise me if this year 10 out of 11 sectors posted EPS gains. That's the US. Major regions, Europe, Japan, Latin America, broader Asia, we think that we're swinging to earnings gains this year. Now, of course, that's what the rally was behind us. But let's just look at the year past. If we took out Mag 7 earnings and have your own view on each individual company there, some good, some bad, maybe. But across the world, EPS fell 7% last year. We're not going to stop this profit recovery in 2024. We think we're going on to further gains in 25. All of these signs, if the economy was hitting its limit, we wouldn't see the unemployment rate rising. So I think that we have the potential to have a much broader market. Last year, the smallest number of shares, the fewest shares, beat the S&P 500 since 1998. I think it's already improving across industries. There'll be setbacks like today, where we don't know when exactly the Federal Reserve will cut. But we think that policy tightening is out of the way. Profits are recovering. And if we zoom out a bit, I think that labor demand, most of the evidence, it's all conflicting, but the bulk of it is telling us that there's some cooling in the labor market, not in profits. That's still, I think, constructive for financial markets.
We have time for another one. Just want to get your quick take on what other central banks around the world are doing. The ECB just raised rates, so did Bank of Canada. Kind of unusual. Usually the ECB isn't raising first, or the Bank of Canada for that matter. And then there's Japan, another outlier. What do you see the central banks of the world doing going forward for this year?
Well, Japan is the outlier. And again, the pressure to raise rates in Japan is building. The case for Europe and the United States are actually not as different as people think. If we take a look at the harmonized ECB inflation rate for the Eurozone and the same measure for the United States, takes that one component, owner's equivalent rent, the US has had more inflation progress than Europe has. Now, our trend underlying growth rate may be higher, the sustainable interest rate may be higher, but we don't think it's really telling us a different story. That tight monetary policy will interact with labor markets, and we'll see a cooling in inflation. And that's perhaps not maximum employment if we look out 12 months. So I think the Federal Reserve will be doing what the ECB has just done, and they'll take down policy rates a bit. Now, literally, for investors, it really matters the context for this. Is the Fed easing in an economic collapse? That certainly wouldn't be a positive catalyst. Usually, policy easing is not a positive catalyst for credit and for equities markets. But I think this time around, if it's just dialing back and sustaining the expansion a la 1995, then I think that we're in a decent place. I certainly think that's what's happening with Europe, which has had a stalled economy. Now that inflation's come down, even with that economic stall out of the way, the European Central Bank is able to ease.
Got to leave it there. Really appreciate your thoughts here. Thank you, Stephen Whiting.
My pleasure.
You'd think today's job report would be a good thing for President Biden, but is it too good? Here with more is Yahoo Finance's own Rick Newman. Rick, I am fascinated to hear the details on this one.
Hey, guys. Look, I mean, more jobs are really not doing President Biden any good at this point. I mean, we're so far into the point of diminishing returns on his political payback for the great job growth we've had under his administration. 15 million jobs created so far under Biden, the most of any president ever. When he brags about it, it's true. But that is, it's now become very clear. This is not what voters care about. Voters care about prices and inflation. And a strong job market has now become kind of a contrary indicator for inflation, as it has for all the things we're talking about with regard to markets. I mean, markets, for the most part, care about the strength of the economy because of whether and when the Federal Reserve is going to cut rates. Biden cares about the strength of the economy for another reason, because I think the main thing he needs in a bullish case for re-election is he needs consumers and voters to see prices either moderating or outright declining in the home stretch of this election. And I think we're getting to the point, we're just getting one hot number after another on jobs, on incomes. I think we're at the point where Biden is just not going to get the break on inflation that he wants. We all know the economic argument here. The inflation rate, the annual rate of change has dropped from a high of 9% to 3.4%. But as consumers remind me every single time I write about this, maybe the rate is coming down, but the prices went up and they're staying up. And everybody has their own personal inflation gauge, whether it's the price of roast beef or hamburger or milk or your rent Gasoline is obviously an important one. And I just think Biden is not going to get the break he's hoping for, which is that voters see tangible signs that prices are coming down. So he's just going to have to deal with that. Doesn't mean he's going to lose, but I think it does mean we're just not going to see any meaningful increase in Biden's approval rating, which is really low, around 40%. And he's just going to have to deal with that.
Yeah, lots of moving parts here. We will keep track of it all. Thank you, Rick Newman.
Bye, guys.
And coming up, an interview with the Lyft CEO, David Risher. That's next on Market Domination Overtime.
Lyft revealing 2027 financial targets at its first investor day this week. The ride-hailing company expecting a 15% annual growth rate for gross bookings. With more on the road ahead, Lyft CEO David Risher is joining me here in studio. David, thanks for being here.
Oh, Julie, it's great to be here.
So as we were talking during the break, it seems like the market was relatively happy with the guidance that you guys gave. Yeah. So talk to me more about it. The 15% growth in bookings. Mm-hmm. How do you get there? Is it about taking market share? Is it about bringing on new customers? Talk to me about the path there.
Sure. So the first answer is you get there through customer obsession, right? I mean, we're a scale business. So we do 2 million rides a day, every single day, 365 days a year. And if that goes to 2.1, 2.5, 3, over time, that produces, frankly, an incredibly profitable business. And the way you do that is you obsess over your drivers and you obsess over your riders. And that's sort of it. I mean, we're looking at $25 billion in bookings over the next 3 years by 2027. And the only way you get there is just blowing your customers away.
I'm so fascinated by this because when I think about Lyft versus Uber, obviously your biggest competitor.
Who?
How are customers making that choice, right? Are they making it because they think Lyft is a better experience, or are they just looking at the apps and saying, this is the lower price, and it's going to get to me sooner?
So people do both, right? There are definitely some people who are price shoppers. There are people who are time shoppers, right? Who's faster? Right now, I'm super happy to say that basically our timing is right on. It's right on. Like, you're not going to see a big gap there. And neither with price. In fact, often we're going to be a little bit cheaper there. So that's wonderful. But I think that's just the starting point. I mean, with so much in life, yeah, you worry about price, but then you think, is this an interesting or better experience? So that's why we launched Women Plus Connect, for example, that if you're a woman and you want a woman driver, you can do that, right? That's kind of it, and that's only available on us. Same if you want to be picked up on time for the airport. The other guys might say they'll do it, but we'll literally give you $100 back if we're more than 10 minutes late for a scheduled ride. So I think after you get the basics right, you start to build innovation on top of it, and that's how you start to really drive preference.
And are you measuring how many of your riders are single platform riders?
Yeah, sure.
And is there a way of doing that?
I mean, we can get hints. You know, it's a little hard. We obviously don't know all the apps that people have on their phone, but you can kind of get a sense. And it might be 40%, it might be 50%. Frankly, if everyone using the other guy also had us on their phone, I'd be pretty happy. So
as long as they
I'm okay
use you
with
guys
that.
sometimes. If they just have it on the phone.
Oh, no, fair enough. As long as they, but look, flip a coin. Use this half the time and I'd be very happy.
The other half of it, as you talked about, is the drivers. And there you guys have made some progress as well.
That's right.
So talk me through that piece of it.
So here's the thing. In order to have a healthy, we call it a marketplace, a healthy business, you've got to have rider and driver in balance. And remember, drivers are actually our primary customers. There's 2 customers in every car. If you don't have the driver, you don't have anything. Okay, so what have we done? We've put in place a 70% earnings guarantee. This literally guarantees 100%, that every single week a driver will never make less than 70% of what the riders pay after fees, like insurance. Usually it's more like 82, 83, it can be up to 85%. And it's a guarantee. And so what that does is that starts to drive preference on the driver side, right, to choose us over the other guys. And that's why we have more driver hours than we've had in our history as a company.
And so then you get the 15% booking to talk about. So something else when it comes to the drivers, though, is that obviously regulation is something that you, and Uber for that matter, have been talking about around the country. Most recently, Minneapolis, I believe, there was sort of a back and forth about whether a minimum wage was going to be required for the drivers. I believe in the end it was not, although it was
No, in the end we actually agreed to a new minimum pay.
Gotcha. So how do you view those kinds of, I won't call them battles, but obstacles perhaps around the country?
I'll tell you the small and then the big. The small is, I understand, look, different regulators, different cities, different states, they might have a point of view about these things, and that's totally fine. Like, our point of view there is when drivers win, we win. And it's true, right? The more they make, the more we make. The only problem that we have with that, and that's kind of small stuff, is sometimes cities and states will sort of try to go so far that they actually force us to raise rates so much that riders then suffer because they just can't afford it. So I don't like that. That's bad. It's bad for riders. It's actually bad for drivers. They make less. That's let's call it a small problem. A bigger problem is there are some places that have a view that say, well, drivers who love the gig economy, and I'm really serious about that. These are drivers who say, there's no other job I can have where I can, get on the platform today, get off tomorrow. I don't have to quit if I don't like it. I don't have to go through a hiring process if I don't have to I don't have to tell my boss when I'm coming to work or when I'm not. Like, that kind of flexibility, so important to them. And I think there's some people around the world who still don't quite understand, like, this is a real thing. As I say, we have more drivers on the platform than we've had ever, yet unemployment is basically at an all-time low. So that shows you people really like it. And when people start to sort of fight against that I sort of object to, because I'm like, you know what, actually don't speak for the drivers, talk to the drivers.
There's a couple expansion questions I want to ask you. You guys are in Canada now. Your Canada numbers were really good.
Thanks.
Anywhere else?
So not yet, but I think that the fact that we're doing well in Canada is a really good indicator, because what it shows is that our customer-obsessed, kind of approach can work outside the United States. We've seen our share in the Toronto area, for example, go up from roughly 12% to roughly 30%. I mean, it's really been significant, just over 6 months. So that shows that when we really put our mind to it and focus on it, the same customer-obsessed focus for riders and drivers can work elsewhere. But nothing more to say than that.
And then the other area of potential expansion, there was one analyst earlier this year who said, oh, maybe Lyft should get together with DoorDash and do some sort of partnership for food delivery. Is that anything that you guys would consider, or are you firmly focused on being a pure play?
You know what? I think we can do both. In other words, I think we can be purely focused on a pure play, and that's absolutely right. We're all about trying to get people out in the world, connected to the world, more like that. But that doesn't prevent us from doing partnerships. Look, we do partnerships with Delta Airlines. We're not in the airline business, but I tell you what, it's great to be able to earn Sky Miles on Lyft, and it's great to be able to get a notification saying this Delta flight is a little bit late, so you probably don't have to leave for another 10 minutes. So, if we end up doing those sorts of partnerships, they're ones where they benefit both companies and they benefit our riders and our drivers.
All right, David, thanks for being here. Really
Yeah, it was a pleasure.
appreciate it.
Yeah, of course.
Thanks for coming in.
For sure.
Jared?
All of our major averages locking in a winning week as investors digest a stronger than expected jobs report. And joining us now with her top takeaways from the trading day, let's bring in Yahoo Finance reporter, senior reporter, Alexandra Canal. And you were there at 8:30 a.m. So was I. It was an eon ago.
Oh, yes. I know. It felt like a lot has happened since then, but you said it, right? Jobs day in America, and that really dominated the story for markets. We saw jobs come in much stronger than expected, the unemployment rate ticking higher at 4%. And if we pull up an intraday chart, it seems like the markets really struggled to figure out how exactly to play this throughout the day.
It wasn't a lot of volatility in the indices.
Exactly. And a lot of this comes from the fact that rate cut expectations are changing now after this print came. We still have most traders expecting a rate cut to come in September, but the odds are less than what we got before this hot print. So that's something that investors, it's top of mind for traders moving forward. At the same time, some economists have come out and said, look, at the end of the day, this shows underlying strength when you think about the economy at large, as well as the labor market. But I want to take a look at some other areas of the market that we saw move on the heels of this jobs report. One is the small cap
Ending
index.
in the red for the week, too, I would
Right. And if you take a look at, let's look at a 3-month, a longer term. So we've seen the small cap index remain really under pressure as we've gotten this higher for longer mantra from the Fed. And then if we take a look at a shorter term, you'll see after that jobs report, a lot of struggling there with small caps. And then I also want to talk about the 10-year Treasury yield.
Big move today.
Crazy, 15 basis points higher, just around 4.43% under that critical 4.5% level. So various moves here based on that report.
All right, what is your next takeaway? We've been watching a lot of things here today. I don't think it's time for meme stocks yet either. The next one. Okay, here we go.
Stocks still records, Jared. You know, they're hovering at records,
Almost lost track of that for a second.
Exactly. The S&P was so close to notching another record there. It fell a bit short. Obviously, the S&P, it's been increased by those large cap names, Nvidia hitting the $3 trillion mark. But it sort of speaks to this narrative that perhaps we don't need the Fed to cut rates in order to see this resiliency in stocks. And I love this chart. It's from FactSet. Earnings growth, robust earnings growth. That's been keeping this market elevated. And the estimates as we head deeper into the year, they're expected to remain elevated. So that has been very encouraging for strategists as well.
Yeah, it's been nice to see us kind of climbing out of this earnings recession, much different from a regular recession. All right, now I think it's time for meme stocks.
You teased us, Jared.
All right, deep tease there.
GameStop. All right, the return of Roaring Kitty. He returned to the live stream format the first time. We all watched.
Yes.
He was a little late to the party, but when he did finally show up, he was in front of a live chart from Yahoo Finance, which was really fun to see.
Right there.
Exactly, right there. Now, he spoke, it wasn't, I don't know what your thoughts were.
Well, you know, I think he was very conservative. He was giving more risk disclosures than I was used to. But I mean, I think the whole thing boiled down to trust Ryan Cohen.
That's what he said.
Except we don't know what Ryan Cohen is thinking yet. So I don't know. I don't know if the Best Buy and, Bed Bath & Beyond shareholders like what Ryan Cohen did with that company. You know, who knows what we're gonna say a year or two from now. But he did make his return.
Exactly. But look at the stock move, right? We closed down 40%. Let's see what we are on the
17 volatility halts.
Exactly.
And that was only today, by the way.
And look at these wild swings that we saw just throughout the past 5 days. We do know that GameStop filed to sell another 75.
Can you put a 5-year chart down there? And then we'll see the initial ones. What's interesting to me is we have this kind of lower highs here and diminishing returns for all these new meme stock revivals. And then this one right here, that's a trend break. So, you know, you have a higher high, that's indicative of a trend chain. Are we going to see a higher than that? I think that's going to be the big call here.
And will he keep coming back for those live streams?
I hope so. Just try to be on time, please.
Exactly.
All right, Allie Canal, thank you. And Julie, back to you.
Thanks, Jared. And that'll do it for today's Market Domination Overtime. Be sure to come back Monday, 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton, and for the next half hour we'll be breaking down the trends of today that will move stocks tomorrow. Here are some of the trends we'll be diving into. What cooled down? The U.S. adds far more jobs than expected in May, bucking fears of a labor market slowdown and pushing out expectations of rate cuts. What goes up must come down. GameStop shares plunging roughly 40% after investor Keith Gill, aka Roaring Kitty, takes to YouTube for the first time in years to reiterate his support of GameStop and its CEO, Ryan Cohen. And let them buy shares. Nvidia's 10-for-1 stock split will slash the cost per share for the chipmaker giant starting Monday and opening the door for more retail investors to potentially buy into the AI hype. Well, Nvidia executing that 10-for-1 stock split after the close today, with the stock closing at about $1,209. So shares will begin trading on a split-adjusted basis when the markets open back up on Monday. For more on what this means to investors and the AI trade broadly, we're bringing in Paul Hickey, co-founder of Bespoke Investment Group. Hey, Paul, good to see you.
Hey, you too, Julie. How are you doing?
I'm doing great, thank you. This has been a fun story to watch, the Nvidia story that is, with the stock split being the latest news there, along with the earnings. And I know you've written a lot and thought a lot and looked a lot at the trading patterns that we have seen in Nvidia. So as we now factor in this stock split, what does that do to sort of your view on the whole phenomenon?
I don't think the stock split is much of a big deal. I mean, yes, it allows retail investors to buy shares of it. It's a lot easier to buy $100 stock than a $1,000 stock. And while brokerages have fractional shares, it never sounds good to say, hey, I bought 1/10 of a share of Nvidia. So I think in that respect, psychologically, it's a good thing there. This run that we've seen, though, is just unlike anything we've ever seen. You go back to all these comparisons. We just think about the last year with Nvidia. It went from 1 trillion to 2 trillion market cap in 9 months, and then went from 2 trillion to 3 trillion in about 3 months. So in just the span of a year, it's added 2 trillion in market cap, which is more than Amazon, is like the entire market value of Amazon. So that kind of run is just insane. It's up 22,000% over the last 10 years. And if you look at all the other mega caps today, over any 10-year period in their history, Microsoft is the next closest, as it went up about 13,000% in the 90s. So this kind of move is unlike pretty much anything you've seen amongst current mega caps. But it sort of reminds me, if you remember back to the late 90s and Cisco, the run in Cisco. Cisco was in a very similar position in the internet as Nvidia is within the AI space today. So that's something to keep in mind. And when we did a comparison of Cisco following the IPO of AOL in the early 90s, which was a seminal moment in the early days of the internet. And if you compare that to how Nvidia has done since 2016, when Google first Sundar Pichai said that we're now an AI first company. So that was a seminal moment in AI. And you compare the runs of those stocks over those periods, they're nearly the exact same up until this point.
Well, here's my question about that, Paul.
Yeah.
When Cisco had that run, what was its PE, right? So, to me, that's been one of the most interesting things about Nvidia is that even as the stock has skyrocketed, because the earnings are kind of keeping pace here, the price to earnings ratio has not gone crazy.
Oh, no, you're absolutely right. And so I wouldn't say that Nvidia has to crash from here by any stretch of the imagination. But what this stock has done is it's to keep that growth pace going forward. It's just the numbers are just become too high, and it just takes up all of the other market cap of the companies in the market. So I think it's an unsustainable pace. But the key is to remember is back in the 90s, Cisco had the monopoly on routers. There were other networking companies, but if you really wanted to build out your network internet infrastructure, you had to use Cisco products. Today, if you want to build out AI, you have to use NVIDIA chips. And so at both Cisco at that time and NVIDIA now, they have what seems like insurmountable leads. But at some point, the competition, comes into the market. Success breeds more competition. And I think over time, you'll see that. Again, I don't think NVIDIA is a stock that's going to go crashing and burning from here by any stretch of the imagination. But a lot of the move and the positive fundamentals have been priced into the stock at this point.
Yeah, and it's important to keep that history in mind as well. Speaking of history, more recent history, we've got the return of 2021 with the meme stock situation. And I don't know if you watched the Keith Gill live stream today where he was just kind of hanging out, talking about GameStop and also trying to get people to guess what kind of beer he was drinking. Paul, I'm just curious what you make of this, especially, whether we're seeing some parallels with what we saw in 2021.
So, I don't think it's as widespread now as it was in 2021. In 2021, stocks, all these heavily shorted stocks were just going bananas. It wasn't just GameStop. Now it looks more isolated, but GameStop today, the volume was higher than, I think you have to go back to March 2021 to find the last time its volume was this high. I think, there's a lot better ways to waste your money as an investor than to try and ride that stock. But I think it's much more contained, and it's what's the market cap now today after today's move? It's maybe like 6 or 7 billion. So it's I mean, that's like a 10 cents in Nvidia stock right now. So it's very contained, and I don't think it's a broader market issue to worry about at this point.
GameStop's market cap, $9.9 billion, believe it or not, Paul.
Even after today?
Even after today. So I can only imagine what it was yesterday, if that's right. Maybe that's not the closing. Maybe that hasn't been updated for the close. We'll get that number. Paul, it's great to see you in any case. Have a great weekend.
Have a good one. Take care. Thanks.
Coming up, an encore showing of our latest episode of Next, all about the big business of carbon removal. That is next on Asking for a Trend. Rapid advancement in AI has accelerated energy usage for tech companies. That's put the importance of carbon removal technologies in focus. Our Kiko Fujita takes a closer look in this encore presentation of Next.
So the first thing we're going to do is turn our spinner blades on. You can already see a streak where we've already spread out there.
Rick Bennett is a third-generation farmer trying his hand at a new type of fertilizer, crushed volcanic rock known as basalt. The rock dust is considered waste, but one startup is finding new use for it to tackle a climate crisis. Workers here affectionately call this brown mountain. Lithos Carbon considers it gold.
This material is what's chemically reacting with carbon dioxide to permanently capture and sequester it into a form that takes it out of the atmosphere.
It's a process that happens naturally over thousands of years. Lithos Carbon is spreading it on farms to accelerate it to 2 years, backed by a $57 million investment from Frontier, a consortium of companies that includes Meta and JP Morgan.
There are some portions of company emissions that you will just never abate. Recognizing that they have a net zero target and they want to actually get to zero and honor their very public commitments, they have to invest in some sort of removal technology.
Scientists say it's not enough to reduce carbon emissions, but capture them, with CO2 one of the leading causes of climate change, which is why hundreds of companies are pouring into the carbon removal space. The question is, which can scale up quickly, cheaply, with the future of our environment at stake? This is what's next in carbon removal.
We've got drill rigs prepping for the next shot. We've got blasters in here loading for a shot. This quarry is so busy, we blast a couple times a week out here, and that could drop 50 to 60,000 tons of rock at a time onto the ground.
How far down are we?
Right now, we're about 100 foot down in this active pit. State of North Carolina, we can mine down to 500 feet deep. So we're going to be here a very long time mining this product.
This fight against climate change begins with one of the most abundant resources on the planet. Basalt has long been considered the building blocks used in asphalt and concrete. Sunrock Quarry in North Carolina has so much of it, it ships out millions of tons every year.
We take that 36-inch boulder and we crush it down to sand-sized particles that we can put into asphalt and concrete. And from that surge pile, it'll get crushed again, it'll get screened, it'll get washed, and it'll kind of continue on that process until it gets to a final product size and spec and stockpiled.
Sunrock uses every piece of that rock except the dust of waste that piles up in the end.
This is the secret sauce.
This is what we looked all over the country for, is this particular material.
Not all basalt is the quality that Lithos wants. Can you tell by just looking at it, or do you actually have to?
You can't, yeah. So we look at it under an electron microscope. We're looking at all the properties that make it suitable for the carbon capture process, and also release the nutrients that helps the soil and the plants grow in it as well.
It's part of a process called enhanced rock weathering. Carbon dioxide in the atmosphere combines with rainwater to create a weak form of acid rain. When that rain hits volcanic rocks, it leads to a chemical reaction that traps CO2. It's a natural process that takes thousands of years. Lithos Carbon is speeding that up more than 1,000 times by spreading the finest form of rock dust across farm fields. The thinking is, the more surface area the rocks cover, the more carbon is captured. Lithos says all of the rain combined with basalt also helps improve crop yields.
Farms are extra special and extra powerful for a few reasons. One, the roots, they break up the rock dust faster, so that's great. Two, the farmers already need to spread rock dust in their fields. They need to do this to rehabilitate their soils after we use synthetic fertilizers. The farmers, they're already spreading rock dust, and we're actually replacing something they already do today with something that works even better. So it's plugging into existing infrastructure, piggybacking on that, and allowing us to scale this climate crisis faster.
So the drill goes in, it pulls the dirt right up into the bucket.
The soil is manually tested every 2 acres every 6 months to measure the amount of carbon captured. Enhanced rock weathering is one of many solutions in a growing industry with demand projected to quadruple from 2030 to 2040, according to consulting firm BCG. There are already more than 220 carbon removal companies globally.
There's multiple different pathways, chemical pathways for which you can take CO2 out of the air. And no one really knows for sure yet which ones are going to be able to scale the fastest and come down the price curve most effectively. And so it really starts to become a complicated puzzle of which technologies work in the right atmospheres or in the right environments to optimize all of this. And we need some of all of them.
This satellite image of carbon in the atmosphere points to the scale of the problem. Humans have dumped 2 trillion tons of CO2 into the air. pushing global temperatures more than 2 degrees above pre-industrial levels. The UN panel on climate change says we need to remove up to 10 billion tons per year by 2050 to avoid the worst impacts of climate change. That amounts to roughly 25% of annual carbon emissions today.
Most expect that many of those emissions will be eliminated through various reduction measures. So more efficient motors, cleaner power, et cetera. But there is still a large amount of emissions that ultimately will have to be taken out of the atmosphere in some way if we want to get to net zero.
That's where carbon removal comes in. Even with all of the efforts to decarbonize, BCG's current mystery estimates companies will still fall more than 30% short of their goal to be truly net zero. That means they'll need to buy carbon credits from companies like Lyft to offset emissions they can't reduce on their own.
I think all of these sort of front runners in the carbon market, they're not just interested in what they can buy today, they're investing in the future of the carbon dioxide removal market. The scale of the problem, they recognize that investment is needed. So they are looking to kind of support pathways.
There are a lot of ways to remove carbon, but there's a trade-off between affordability and reliability. Direct air capture has the simplest measuring system, but it requires building large factories that can suck CO2 out of the air. It costs up to $1,000 to capture a ton of carbon. Methods that rely on agricultural waste are considered cheaper, but it requires a lot of land. Enhanced rock weathering uses a smaller footprint, but critics say there's too much uncertainty. There isn't enough data to show how effective the process is. Planting trees may be economical, but Mystery says the carbon storage isn't as permanent. Precise measurements are harder to come by.
You can estimate how much carbon is in the tree, but there are questions like what happens if it gets cut down? What happens if there's a forest fire? And so in all of these technologies, they all have various pros and cons, but in general, the higher quality ones or the higher durability ones are the ones that are closer to I can touch and feel and I can see this much has been removed and someone can put a stamp on it. Another question related to that is what is the relative value or quality of the different credits, right? Buyers want to have confidence that they are purchasing actual carbon that's been removed. They don't want to purchase something and then find out they didn't actually remove on their behalf.
It's a big reason why companies with the most aggressive climate commitments are backing new technologies. BCG estimates this market could reach as high as $135 billion by 2040. BCG's invested its own money, signing partnerships with direct air capture companies like Climeworks to remove more than 140,000 tons of CO2 combined from the atmosphere. Companies from Alphabet to JP Morgan have invested more than $57 million in Lyft as part of a consortium known as Frontier. The funds agreed to buy 154,000 tons of carbon from Lyft in the next few years. Combined, Frontier's committed to buying nearly $1 billion of carbon by the end of the decade.
We are moving so much material that anything that we can do to optimize the movement of that helps. So part of these large offtake agreements, what they allow us to do is start leveraging more efficient methods of transportation like rail or like barge. Those methods can be extremely, extremely efficient, but you need to move a lot more minimum volume to get there.
Impact is still hard to quantify, though companies are required to measure and verify carbon credits that are sold.
One of the most important things is that clear MRV, the monitoring, reporting, and verification. If you can clearly articulate and prove that you have captured a ton when you say you've captured a ton.
But there's not a universal standard right now, correct?
That's correct. And it gets really tricky when you start to look at different technologies. With enhanced rock weathering, you take rocks, you scatter them, and these rocks will absorb CO2. And in these situations where you have the capture occurring over, it could be acres, it could be thousands of acres, you can't possibly measure every single rock, right? So how do you sample it and come up with an agreed upon number that is the removal that can then be sold?
Soil samples can point to the amount of CO2 captured on farms, but that carbon doesn't stay locked up until it makes its way to the ocean, where it's sealed off for good.
So what you actually measure here is not necessarily ultimately what becomes the credit.
That's correct. Yeah, this is sort of the initial step in the process, right? What we're measuring here is exactly how fast the rock is dissolving in the field, how much carbon dioxide that is pulling down, and then we look at all the downstream effects. We call it kind of like a cradle to grave accounting, right? So we look at the effects here, we look at what's happening in the rivers, we also even model what's happening in the oceans. We take all of that into account before we kind of say, hey, here's a ton of carbon that we've captured.
We're doing custom application here. We're actually applying basalt, the material here, for another farmer.
Farmers like Rick Bennett are keeping a close eye on their fields. Litho says the tiny rocks are helping improve crop yields by up to 57%. In addition to handling and paying for every step of the process, Lithos pays him. Farmers get $50 an acre as part of the program.
What's the result been from a yield perspective? Has it actually improved the quality of the soil? Has it improved your yield?
We have only had one season with it on the land. We truly, in our test, didn't see a yield increase last year, but we also did not lose any ground on our yield from the previous year. So we're excited to measure the results again this year. We think there'll be definitely a yield increase.
Lithos expects to capture up to 50,000 tons of CO2 on farms this year. Hundreds of other farmers are waiting to partner with the company, but they'll need to scale much more than that, with demand for carbon credits far outpacing existing supply in the market.
Our goal is in the next 3 to 4 years to get as much data as possible that allow us to go the full way. Models that will allow us to say, hey, we know the soil types, we know the crop types, we know the climate. We see ourselves building something like the Google Maps of enhanced weathering. From there, being able to scale down our measurement costs that are really taking the whole lion's share of profits at the moment, scale down those costs, reach more farmers faster, scale this up for society.
The need is so great, right? We are at the kiloton scale today. We need to get to the gigaton scale in the future. That is a factor of 1 million growth. Today, CDR is an optional thing, and it's starting to change, but until it becomes required, it's only going to be limited to those who are willing to do it voluntarily. The only way we can scale the technologies as fast as we need is if many of them succeed. So this isn't, I need DAC and not trees. This isn't, I need enhanced rock weathering and not biochar. This is, I need all of it, and I need all of them to scale.
The EU and the US have proposed guidelines to scrutinize the quality of carbon credits in the voluntary market. But Mistry says mandating offsets are critical to bringing costs down, a necessary step to getting companies to their net zero goals. Lithos currently charges $370 a ton. The goal is to slash that to 100.
So our goal is to be capturing billions of tons of carbon dioxide using enhanced rock weathering. We know that's possible. Our goal is to really be at maybe 2 to 6 billion tons worldwide.
How many farms do you need to spread this across? How many acres do you need to cover to get to that goal?
It's not even all of the world's farming land. It's actually just a fraction of it. So in America, if we just focus alone on corn and soybean crops, and there's many other things we grow, obviously. But if we just focus on that alone, we believe we could capture up to 0.7 gigatons, so 700 million tons of carbon dioxide. So that's the key.
Time now for what to watch next week. On Monday, all eyes will be on Apple, the tech giant hosting its Worldwide Developers Conference, where investors and consumers will get the first look at Apple's AI strategy. The company is expected to lay out details as it lags behind the competition in the AI space. Also on Monday, Nvidia shares will start trading on a split-adjusted basis, the company completing a 10-for-1 stock split Friday after the close. Meantime, the economy will be in focus on Wednesday in particular. The Federal Reserve decision is coming, and while no rate cut is expected, we will be getting an updated dot plot. Fed Chair Jerome Powell will hold a news conference at 2:30 p.m. Eastern. But ahead of the Fed decision, we'll get CPI print for May. Economists forecasting core CPI, the Consumer Price Index, to come in at 0.3%. On the earnings front, tech in focus with Oracle, Broadcom, and Adobe all on deck. And finally, the fate of Elon Musk's $56 billion pay package will be decided. Shareholders will vote on the controversial plan at Thursday's shareholder meeting. That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern, and have a great weekend.